Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Wednesday, April 28th, 2021, and I am pre-recording this Trading Places Live for Thursday, April 29th. Futures currently are pretty strong. We had some great earnings overnight. After the bell on Wednesday, we got reports from both Apple and Facebook, both up significantly after hours, especially Facebook on a percentage basis, and that is leading the NASDAQ to the upside with futures on the NASDAQ up more than 100 points at last check. Dow futures, S&P futures also higher. So it looks like, barring a reversal overnight, we should be moving higher into the open on Thursday. And I believe the NASDAQ could be at an all-time record high when that bell rings in the morning. So we'll see whether or not we continue to get some follow through there. Let's go over the agenda for today. I'm going to have the daily market recap first, as I always do, and then we'll get into talking technically. Want to look a little bit at the dollar. I think the dollar is giving us a little bit of a head fake right now, and I'll explain why. Small cap analysis. I think it's probably time to take a look at the small caps. We're starting to see the small caps move up again. And so I've got interesting ETFs to look at on a small cap basis relative to their larger cap counterparts. Then we'll get into earnings spotlight. A lot of earnings out, as I mentioned, Apple and Facebook, but there were dozens of others as well. So we'll go through a bunch of those. And then we'll wrap up with the three you must see. Got three energy materials names that I think are worth taking a look at. One that's breaking out, one that's strengthening, and another one that's trying to break out. So I think that'll be those will be three good charts to take a look at today, and that'll be it. But before we get into that, I do want to just take you over to earningsbeats.com. If you're new to Earnings Beats, love to have you join our Earnings Beats Digest newsletter. It's a free newsletter, no credit card required. You can unsubscribe at any time. All you have to do is go to earningsbeats.com, type in your name and email address, hit that subscribe button. We'll get the newsletter out to you. It does go out 3 times a week, Mondays, Wednesdays, and Fridays before the market opens, and usually very educational, talking about earnings, relative strength, those types of things. Moving on to the daily market recap. Dow Jones Industrial Average on Wednesday down 165 points. S&P down only 3.5. So definitely a little difference depending on which index you're looking at. And then right in the middle of the two, the NASDAQ dropped a little more than 1/4%, down 39 points. It is above that 14,000 level. It's still trying to make the breakout. And as I mentioned earlier, I think with the Apple and the Facebook reports, unless things change overnight, I believe we're going to be opening up at an all-time high on the NASDAQ, and that is very bullish. One other thing to mention, too, is historically, if we get the breakout technically, you have to keep in mind, historically, the April 28th, 29th through about May 5th, that period is one of the more bullish periods historically in the market on the S&P 500. So, anytime I get technically a breakout and then followed up with seasonal strength to confirm, I normally am pretty bullish. And I've been bullish on the market for quite some time. I see no reason to change at this point. The numbers, the earnings coming out are stunning relative to estimates. Now, I do know, some of the companies that are reporting really strong numbers are pulling back. We're seeing some sell-offs after earnings are being reported, but many of these companies had huge run-ups in the last year. And so they're in these consolidation periods or consolidation zones, I should say. And so a lot of the action that's taking place to the downside is within this consolidation range on many, many stocks. I've been seeing this pattern develop on a lot. So I think eventually these companies are going to break out again. But I think they're trying to grow into that market cap that was established throughout the past year. Many of the technology names, many growth names went up significantly, now coming out and reporting solid earnings, but many of them not following through with movement to the upside. But I honestly don't think that's a problem longer term. I just think short term, it's going to lead to a lot of frustration. Anyway, getting back to these charts, mid caps, small caps, you can see mid caps were roughly flat, small caps up just a tad. fractional. So looking across the 5 indices that I show you here, small cap's the only one to finish in positive territory. That's why later I want to take a look at some of the small caps and analyze some of the different areas. Among the sectors, energy, the best performer, up 3.45%. That's a huge number. I think we broke out of this bullish wedge. So we had an uptrend in play. If you connect these highs coming across here and then connect the lows, it's like a narrowing piece of pie or a wedge. And after an uptrend, they're considered bullish wedges, and you expect a breakout. And I believe we just got it. Look at the volume pickup. I think that's a really bullish development in energy. I think we're going to see higher prices in energy as we go forward. Communication services made the breakout intraday, could not do it at the end of the day, however. So tomorrow will be interesting to see whether communication services can follow through with the overall market, with the NASDAQ to the upside. It would be bullish if we did get that breakout on communication services. Technology, I think we're going to get that breakout tomorrow. I just think that with the news on Apple, their earnings were $1.40 versus $1 estimated. I mean, for a company that size to be beating by that wide of a margin, and then and I'll talk about this in a little bit as well, but they authorized another $90 billion in share repurchases. So it's hard to imagine the stock going down when you know that they've got all these buybacks. Anytime the stock goes down, you're going to have buyers. You're going to have Apple buying its own stock. So anyhow, I think the XLK looks pretty good here. I did want to mention in the oil patch, the DJUSOI making this breakout above the 20-day. See how we failed for the last month or so? Every rally attempt has failed at that 20-day. Well, that changed on Wednesday. We actually got the breakout. That was good news. And then over in consumer discretionary, travel and tourism, which is a group that I really like, I think it's just setting up for a breakout. I mean, whether or not you look at this as maybe an ascending triangle, it's a little sloppy, or you could maybe even call it a symmetrical triangle. That too would be a little bit sloppy, but I think ultimately we break out above the high that we had established back in March. Moving on to the 10-year Treasury yield. We did have the Fed come out today. Really no surprises. I mean, the Fed said essentially what it's been saying, that inflationary issues, and there are some in the near term, but the Fed believes they're transitory. They also are fine letting inflation run a little bit above the 2% target level. They are not in any hurry to raise interest rates. They believe the economy is strengthening. They specifically mentioned the vaccinations taking place across the country. And, the Fed's got the markets back, and you can argue with that and debate that all you want. But unfortunately, I don't like to fight the Fed. When the Fed is supporting the stock market in the way that it is, and all their policies, to me, point to higher equity prices, I just think it's dangerous to try to bet against that. Looking at the 10-year Treasury yield, I mentioned in my report to Earnings Beats members, the 150 to 175 range, I think, is this consolidation area off of a significant uptrend. If you draw a trend line off of all these lows, it's probably in the low to mid 140s right now, 1.45%, something like that. And that'll continue to rise. So if we do pull back one more time in the yield and get back into that 1.50, 1.50 area, I think it's also going to be hitting a trend line support. So keep that in mind as well. When we got the negative divergence on the yield just about 6 weeks ago, I was looking for a PPO centerline test. We've gotten that. I was looking for a 50-day test. We've gotten that. So I think the 10-year Treasury yield here is free to go either direction. But my guess is, and maybe it's just more of a gut feeling, I think we're going to continue to see this sideways consolidation for a period of time. But I do think ultimately we break out to the upside. I think yields are going to head back above 2% in 2021. I would not be surprised to see 2.25%, 2.5%. And while some might say, wow, that's a lot of movement to the upside in interest rates, that's going to be horrible for the stock market, I would argue the exact opposite. I think that the economic activity is going to strengthen to the point where the growth is going to be so great that it's going to far outweigh the slight movement to the upside. And you may say, well, that's not slight movement if it goes to 250 from 162. But I think, when you look at where we've been historically, even 2.5% on the 10-year Treasury yield would be an incredibly low rate. And when you think about that, our economic growth, our GDP in 2021 is likely to be higher than any year since 1984. That combined with historically low interest rates, um, I don't think there's a lid to be found on this market. I do think over the summer we might run into some seasonal weakness there. Perhaps we see a 5 to 10% pullback correction, but I think going into the fourth quarter, we're going to see tremendous strength in the market. I think there's an outside chance the S&P 500 could get to 5,000 this year. That's, we just got through 4,000. My prediction was not 5,000. I think my prediction was closer to about 4,700 into the year. But I wouldn't be shocked. I would not be shocked if we saw 5,000 on the S&P 500 before the end of the year at some point. All right. Anyway, 10-year Treasury yield, I think right now is just in the middle of a range. I think it consolidates. Now, one of the things that was interesting when the Fed announced today, I don't know if you followed this at all, but this is a 5-day chart of the U.S. Dollar Index Bullish Fund, the UUP. And when the Fed came out and basically supported the market, said, hey, we're not doing anything. We're not raising rates. We're still going to be very accommodative, very dovish. One of the things took place was the dollar sold off. And you can see that right here in the UUP. We were at 24.48 right about the time the announcement came out. And we finished at 2.43, 24.37. We were at 24.48. We fell to 24.37. That's a pretty decent drop in just a couple of hours on the dollar. So I think what we're seeing is a head fake, and I just will point out to folks, if you haven't followed this chart that I like to show, the 10-year Treasury yield here in the U.S. minus the German 10-year Treasury yield. Here's the chart. And so this top part, this 15-year chart, and all of this, by the way, this is part of the talking technically, really, that I wanted to get into today. But this 10-year Treasury yield here in the U.S. minus Germany, if you follow the difference in the yields between the two countries, it looks pretty similar to the dollar index. When the U.S. and let me back up for a second, because when I learned economics long time ago, I was mostly interested in what interest rates were doing in the U.S. And that kind of influenced what was going on with the dollar, because back when I studied economics, there wasn't nearly as much global dealings and transactions and so forth. Now, everything is so much more global oriented. And, businesses, online businesses, I mean, you can open a business and be doing business in China the next day. That was never possible. We didn't have those avenues many years ago. I'm talking, 3-4 decades ago. And so now when you look at the dollar, you have to really look at interest rates between countries. And the two that I find are most interesting from a correlation standpoint are the US and Germany. And we just seem to have strong positive correlation in our equity markets. And when you look at the dollar, there seems to be a very strong correlation between the direction of the dollar and the direction of the difference between the yields in the US versus Germany. So if the yields are rising faster in the US than Germany, I mean, technically that's giving us a pretty good indication that our economy is stronger. If our rates are going up faster than Germany's, that's normally a sign that our economy is stronger. Well, if our economy is stronger, that should also lead to a stronger dollar. And that's essentially what we see. And here is your proof down here at the bottom. This is a correlation that tracks the 10-year Treasury yield minus the German 10-year Treasury yield and how that relates to the dollar. And you can see that we spend most of our time in positive territory. Right now, we're up 0.89. So it's they're going almost hand in hand. Now it is topping and it's starting to roll back over again. And the reason is that while the dollar is coming down, or why the difference in the yields is coming down, the dollar's coming down a lot faster. And so I think we're probably topping on the correlation, probably going to start coming back down, especially if the dollar continues to weaken. But the key here is that yields in the US have been going up versus Germany now pretty steadily for the past 9 months or so, 8 or 9 months. And yet the dollar has struggled to move higher. It was starting to, but then just recently with this downtrend, it's gone back down again. This is why I don't think it's going to last. I don't think the dollar weakness is going to last. And it's also why I believe you have to be very careful with gold and gold stocks, mining stocks. Because if I'm right about the yields going up faster in the US and the dollar eventually following suit to the upside, that's going to put pressure on gold stocks, miners, all of that. So I would be really careful and continue to monitor what's going on in this relationship between the bond market in the US versus the bond market in Germany. All right. Couple of things we need to at least be aware of for tomorrow as well, Thursday, is we do have our Q1 GDP coming out. So it's going to be our initial estimate. And that estimate right now is 6.5%, although that's the consensus. The numbers are all over the place. I think I saw something as low as 4. I saw something as high as 10. So the estimates are all over the place, but the consensus is around 6.5%. Q4 GDP was 4.3%. So we're talking about a significant increase in the first quarter. And I think it's going a lot higher later this year. I don't even think the first quarter was just kind of dipping our toes in the water. I think as things begin to reopen, well, they already have begun to reopen, but I think as they fully reopen, which I think is going to take place later this year, I think there's so much pent up demand. We're going to see GDP soar. Initial jobless claims also due out. And all of this is going to be impacting interest rates. That's why I'm mentioning it. But initial jobless claims will be due out in the morning as well. Estimate is 558,000. Last week was 547,000. We've been seeing some pretty good positive surprises. Maybe we'll get another one tomorrow. We'll have to see. And then at 10 a.m. on Thursday, March pending home sales come out. February, if you remember, was down 10.6%. March is expected to jump 3.8%. So anyway, some pretty good information there. And information that we'll need to watch very closely tomorrow and the market's reaction to it. Small cap analysis. Let's move on. So we've got the Invesco has some of these small cap funds, and I like to track how the small cap funds in the various sectors are doing relative to the large cap sector ETFs. So in this case, I started off with PSCE divided by the XLE. And the reason that I think this is pretty important, I'm going to go over here for a second and just put in the XLE. So you can see the XLE, and I mentioned this at the open. You had that downtrend line connecting the tops and the bottoms. You can see this. So that was that bullish wedge. And it looks like we've broken out of it. Well, the thing you need to understand is that we bottomed on the XLE back at the end of November and had this huge run. But since the end of November, if you look, we've actually had relative strength in small caps versus the large caps. Now, when we were weak, we also saw small caps underperforming during the weakness. But now I just showed you the XLE breaking out again out of this wedge, starting to turn higher. And if you look at the PSCE relative to the XLE, we're doing the same thing, turning higher, just moving back through that 20-day moving average. So I think we've got some pretty good action here beginning. And if energy continues to move up, which I think we probably will see, I believe small caps will outperform the large caps. But that remains to be seen, I guess. But I do like the PSCE over the XLE. And when energy gets going, that usually sends a small cap index higher because there are a lot of small cap energy names. All right, let's take a look at another one. How about PSCT? versus XLK. Again, small cap technology versus large cap technology. And again, recently we're starting to show strength again, trying here to get back up through the 20-day. We're right at it. So tomorrow, with Apple coming out with a good report and probably gapping higher, it'll be interesting to see whether or not the PSCT outperforms the XLK and makes that breakout. How about the PSCD versus the XLY? So same thing, small caps versus large caps, but this is in discretionary. This looks pretty good. We got back through the 20. We're actually hovering just above the 50, and the 20 is starting to turn back up toward the 50. So this relative ratio, I think, looks very strong in small cap consumer discretionary area. Now, when you look at some of the defensive areas, it doesn't look quite as good. So for instance, pull up the PSCU versus the XLU. Here, you can see we went up through the 20, but now we've come back down, potentially breaking back down. I think one that's even more troubling would be consumer staples, which is PSCC divided by XLP, which went above the 20 and then turned right back around, back down beneath the 20. So we'll see whether or not we can turn that back to the upside. All right, moving on. How about earnings spotlight? We got a ton of earnings out. I'm just going to go over a handful of these. I mean, we could spend an hour and a half looking at charts just on companies that reported earnings after the bell. But let's pull up Apple. Obviously, that's a big name. Everyone's interested in Apple. Apple's been trading better. We moved back up through the 20. The 20s crossed the 50. So we got that golden cross. When you look on a relative basis, however, Apple has been downtrending for a while. So is the earnings report going to create a situation where Apple begins to lead again? That's, I think, the biggest question as we go forward. I fully expect Apple's going to have a good day on Thursday. I think at least we're going to start off good. Now, we're not going to get a breakout, I doubt, on the open. So I think we could go either way after the opening bell, but I do think we'll probably move up and at least test that 140 area, maybe 139, and then perhaps see some short-term profit taking. But of the 35 companies, and there were 35 of them that I looked at as far as their earnings per share and looked at charts. Of the 35 companies, 34 beat earnings estimates. 34 out of 35. So companies are not having problems beating estimates, which means a lot of estimates are going to get revised higher, which means the PE ratios are going to be coming down, because if price is X and earnings go up, then the P divided by E, or the PE ratio, is going to come down, unless prices keep going higher, which I think they're going to. I think not only are earnings going to be good this quarter, I think earnings are going to be exploding going forward. So I think there are going to be a lot of estimates being revised higher, and I think multiples will expand because earnings are growing rapidly and beating by wide margins. All right, how about looking at Facebook? Facebook was expected to come in $2.36. They came in $3.30. Just blowing the number out of the water. Facebook was up 6.15% after hours. So very, very strong. How about Qualcomm? Qualcomm expected to produce $1.67 in earnings. They came in at $1.90. They were up 5.25% after hours. So it looks like it's going to hold this 20-day and break out to a new high. But there are plenty of companies who are still reporting great numbers, but are not getting those positive reactions. Another one after the bell was ServiceNow, NOW. Huge run from last year through the high in February. And that's when many of the growth stocks started getting hit, mid-February. So you see ServiceNow trying to come back up, not breaking to a new high, but at least getting some of the February, March losses back. Well, stock down 6.9% after hours. They came in with a $1.52 in earnings. Market was expecting a $1.34. So an easy beat on the bottom line, but some companies are not being rewarded. And I think that's because many of them were already rewarded handsomely last year. And the numbers right now just aren't good enough for growth stocks. So many of these growth stocks still taking hits, even though they are posting really good numbers. One of our portfolio stocks that reported after the bell, Align Technology, getting a nice little pop. They were expected to come in with a $1.99 in earnings. They came in $2.49. Like I said, these numbers haven't been close. Align also guided their fiscal year 21 revenues higher. Stock was up 4.34% after hours. Potentially, it looks like breaking out to a new all-time high on Thursday morning, unless things change overnight. Another company that had absolutely blowout numbers, but they do expect to have a little bit of fallout from the chip shortage, and that is Ford. Ford, they were expecting 16 cents in earnings. They came in at 89 cents versus 16 estimate. And you think, wow, stock's got to be up. Wrong. Down 3.22%. Back down close to $12. I mean, it's hard to make this stuff up. But again, short term, we've had a big run. We're consolidating. I would expect probably the low here down near 11 to be the key low. I think middle of March high up around 13.5. That's where I think the key resistance is. And I just expect Ford to consolidate for a while, probably breaking out ultimately. I mean, we're in an uptrend, and I would expect any sideways consolidation to resolve itself to the upside. Let's see if there's maybe another one. How about we'll do HOLX, because this is the one that missed. They were expected to post $2.62. They posted $2.59. They came up 3 pennies short. But worse, they guided their Q3 revenues and earnings per share lower. Not too many companies are guiding lower and missing. But Hologic did just that. Stock down almost 7% after hours. All right. I mean, we could go on and on earnings, but just know that many of these numbers, many of the companies are reporting very strong numbers, and not always resulting in positive reactions. Of those 35 companies that I talked about that I looked at earnings and 34 beat, only 16 were actually up in after hours. 13 were down, and 6 I didn't see a change from the close. So this is what I get back to. It's like a crapshoot. It's 50-50. The numbers are there. The beats are there. The earnings beats are there. But that does not always mean your stock's going to go higher. And that's the part that I think a lot of folks have problems with. All right, let's look at the 3 you must see. 3 stocks in the commodities area. First is Devon Energy, DVN. I like this trend line break and the 20-day moving average break and the accumulation distribution line moving up. I think this one continues higher. Next up, HES. This has been one of the better energy names out there, and that was a huge move on heavy volume on Wednesday, breaking out above this double top. I think HES continues to move higher from here. I like that candle. And then finally, EOG. Big day on Wednesday, but haven't been able to break out just yet. But we're right on the cusp, and look at that AD line ready to break to new highs. All right, that's it for me. I'm wishing everybody a great Thursday. I'll be back next week for your next Trading Places live show. That'll be over at Earnings Beats at 9 a.m. Eastern, on Monday. Wishing everybody a great Thursday. Enjoy the rest of your week. Have a great weekend, and I'll see you next week. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.